Okay. Thanks, Josh. Can you hear me clearly? I just want to make sure you can before I continue.
Loud and
Yeah,
clear.
totally clear.
Perfect. It's just that because when I've had a few conference calls with people around the world using Telegram, there's severe audio quality issues. So I just wanted to make sure because there are quite a few people on this call, but that's great. So I will get kicked off. One moment. Okay, so I'll kick us off. Basically, Josh and I had a introductory discussion on a Twitter Spaces AMA around 3 months ago, I think, maybe 4 months ago. And amongst various things discussed, of course, Cred's future, Jedstar's future also was Phoenix, and how both of our projects would expand our cooperation beyond just the gaming side of things, which is done by a separate company, as you know, Skill Gaming, but now also on the financial algorithm side of things. And very simply put, we launched Phoenix now around 1.5 months ago, and it is slowly growing. Its TVL and number of users continues to increase. And Josh and I felt it would be an interesting opportunity for those of you in crypto that are seeking yield, safe yield. It's definitely not for crypto enthusiasts or, excuse me, investors who are looking to make a quick flip, 2x, 5x, 10x, 100x. That's a separate pot of capital that we would, of course, advise you to continue to do your own research and search those opportunities. But for investors who have capital uh, lying dormant, that is possibly not beating inflation, maybe it's actually losing money on a real basis, and it's sitting in a bank, or if it is capital that they specifically would like to earn a stable income on. So, over the last year and a half, our team did a deep dive into DeFi, of course, and a lot of DeFi is riddled with scam, needless to say. And there are, of course, a lot of competing yield products out there. So, what differentiates Phoenix? Of course, I'll get into that in a bit more depth in a bit, but effectively, we cut through all the crap in the sector. Um, the problem right now is trust. The sector still, despite its evolution, and we're seeing what's happening in the USA, still suffers from massive trust issues and bad actors. Who would have thought? And I'll try and not mention names, but if you think about yield, if you think about staking yield and passive yield, where you park away your capital at a centralized location, who would have thought some of these big names would have actually gone bust so badly in the US, right? And they did. And it's not just a centralized side of things, even the decentralized side of things you see with Luna, Do Kwon, how bad that ended up when people all they wanted was kind of a 20% return a year, which is a lot in traditional investing sense, but in crypto it isn't that much. And people would have never thought that the peg would just fail that quickly, and it failed miserably, and then he just became a fugitive, and that actually precipitated the downfall of crypto. This recent bear market, which has only now started to pick up, it started a massive bear trend that lasted many years, and you had a lot of cascading bankruptcies elsewhere as well. So, with the downfall of major stablecoins and exchanges and staking programs in 2022, traders and investors alike, they are continue to search for real and reliable sources of cash yield. And I say cash yield because I don't know about you, but for me, for us here, right now, the most stable and regulated stablecoin that does continue to exist and has survived very well one recent scare because it had one-to-one backing, properly audited, and it banks with BlackRock in the US is USDC. So for us, we believe that is quasi cash. Getting paid in USDC, you're not going to have problems with an off ramp, with your off ramp from exchanges, regulated exchanges to your bank. USDT, I think there are still questions around that, although they have done pretty well to survive. For me, it's still always a bit of a Six Sigma risk with that project, but let's hope they do well. But with the other stable coins, there are significant risks. Um, Another thing about yield programs, for those of you that have engaged in liquidity farming, liquidity mining, or in general, they tend to lock up your capital or they have withdrawal restrictions. It's not always the case, but it is more often than not the case. As mentioned earlier, inflation is a major problem, although it has come down from its peaks. It really is a significant problem. Depending on which economy you're in around the world, your capital in the bank is losing 5 to 10% a year in real terms, whether you like it or not. And double-digit yield solutions, either offering staking-based yield and illiquid tokens subject to major capital loss risk or artificial sources of revenues that don't last, these are two major problems that continue to exist. So what I mean by this is you will get returns in DeFi even till today, where people may say, okay, you can earn 1% a day or 2% a day. That on the face of it, prima facie, that looks amazing. You are making uh, almost 300-400% a year after compounding, but that's completely unsustainable. The problem with risk and reward when it comes to yield is that they're inversely correlated. If someone tells you that you can invest in a project that'll make you 50, 60, 70% a year, you may make that annualize for a few months, but then what we have experienced in our very long track record of investing is shit happens. It just happens and you don't know where it's going to come from. Yeah, for example, with Celsius and BlockFi and some of these names, it came from counterparty risk. It came from certain bad actors in these organizations basically playing around with client capital, trading it, and what have you. And in the end, the scheme just fell apart, right? But it can also happen with uh, macroeconomic factors that have nothing to do with the project. If you go for very low yield, then your risk is also much lower. Obviously, if you get into real estate, you're earning maybe 3% net, maybe 5% net gross, depending on where you are. And the cash in the bank, quote unquote, is the safest in theory, although that loses money just by sitting there because the interest you earn on deposits doesn't nearly match the inflation that we're having right now. So, um, in crypto, you do get these programs that offer you these crazy yields, but they don't last for too long. There are some programs that offer you very high returns, like 40, 50, 60% a year, but you'll notice that a lot of that return is actually paid in their token. And that might last for some time because what they do is they incentivize liquidity providers to actually hold that token, to provide liquidity for that token, and they themselves earn a yield on that token for providing liquidity in that token. But ultimately, it's a Ponzi scheme. It's basically a self-referential scheme that always unwinds, and there's always selling pressure on that token. So these are all the problems. And what we have done with Phoenix is we've just cut through, we've addressed all these problems and kind of provided a solution to you, which allows you to earn very stable long term yield, right? This is not a short term, get rich quick type of things. So, what exactly is Phoenix? Phoenix is a highly secure, downloadable app for your PC or Mac that allows you to basically become a market maker uh, in DeFi. It allows you to become a market maker and earn real time yield in USDC. Now, liquidity mining is effectively what it does, and it's a complex task. You can certainly do this without Phoenix, to be completely clear, but it requires a solid understanding of smart contracts, technical analysis in the markets, fundamental analysis, what's happening to key macroeconomic data points that could impact the prices of Bitcoin, Ethereum, and what have you, and in general, risk management. Phoenix basically takes care of all of this inside the app for you. What you basically do is you download the app either for PC or for Mac, and soon also for web, and you choose your risk tiers. We have three pools there: Buffer, Cruise, and Ignite. Ignite being the highest yield, but also the highest risk. Then you have Cruise, which is the medium risk with medium reward. And then you have Buffer, which is for those people that have very low risk tolerance and want to take on pretty much any risk. And they're happy to earn kind of close to a 7 to 10% yield per year in USDC. Now, what is happening is on DEXs, decentralized exchanges, such as Uniswap, such as 1inch, such as Trader Joe, there's a range of DEXs. What Phoenix is doing is it's looking at the pools that provide the highest liquidity, the highest amount of liquidities, volume, and also APYs. And it's basically parking your capital there, and it's participating in the global trade of Ethereum, of WBTC, of key tokens that are traded on the Ethereum network. Um, so if you take Uniswap, for example, per day across the entire Uniswap network, I think a few hundred million, maybe even close to a billion of volumes are transacted. As we speak, in the last 15 minutes, um, a few million has already gone through the smart contracts. Now, Uniswap is not a bank; it's not a central exchange. There are all different users that are using Uniswap. When you buy and when I sell, basically the Uniswap matches our trade. And for those of you that understand Uniswap, you'll know exactly what I'm talking about. And a small cut, effectively, is given to the market makers, a small cut in fees. Usually it's around 0.3%, 0.05%, what have you. This is happening on many dexes as we speak. Phoenix basically aggregates this and does this for you passively. So you don't actually have to go in and do this. It is a relatively complex task. And what effectively you're doing is you become part of this global trade in decentralized currencies in real time. For every single order that goes through, you are basically helping that trade happen. Okay. Now, in terms of the risk tiers that are available for you, as I mentioned earlier, there's Ignite. That's the highest risk, highest reward, and the type of yields that you can that one can expect there that the system is targeting is typically 20% in USDC per year. That's pre-compounding, of course. That's pre any you reinvesting that into the system. Currently, since the app has gone live, most accounts are at around 17.3 or 4%. So it's near that 20% rate. I'd also like to, excuse me, I'd like to draw attention to the fact that we have hit a very abnormally low level of volumes in the trade of decentralized currencies in the last 3 to 4 months because of all the uncertainty that is surrounding the space. Things are starting to look good. However, we have now almost 2 years behind us of a pretty bad bear market. Um, whether there's another down leg before the final bull run, time will tell. But what is interesting to know is that data points are starting to improve and volumes will start to improve as well. What that means basically is that when we say 20% plus target returns in the highest risk pool, typically what we have seen in the last 1.5 year internally in participating in these pools is returns of over 30%. So the current levels of 17, 18% that users are experiencing are traditionally low. They should be higher. Um, Now, of course, some of you say, well, what is the risk, right? I've mentioned that the Ignite pool, which targets returns of 20% per year, what is the risk to your capital? Well, the risk to your capital basically is the underlying price of Bitcoin and Ethereum. So if you're generally a bull on the market and you like these major decentralized currencies, then that is what happens in terms of your exposures. Ignite, which is the highest risk pool, has an exposure of around zero point 0.3 to 0.5x to the underlying price. What that basically means is, let's say you deposit $10,000 into your Phoenix account and you're starting to earn immediately, right? Since after you make that deposit, and then Bitcoin drops, let's say by 10%, okay? You will have approximately faced a hit in your account, and it's not a crystallized hit, it's a floating loss because it can recover if Bitcoin rises again, of approximately 3%. If Bitcoin fell by, let's say, 15 to 17%, your hit would be around 7%, 7 to 8%. Okay. Now Bitcoin rises again and it erases those that temporary drawdown. Then of course um, your values also recover to the original. So this is a concept that we define in the app known as gearing. Now for cruise, which is the second pool, which is the medium risk tier, the target returns in this tier are around 12%. And that can be 10%, that can be closer to 15%. It depends on the year. And the gearing there is lower than Ignite. What that means is that if Bitcoin falls by 10 or 15%, your drop there would be just 2 to 3%, maybe 4% in that type of range. It's also worth noting that if Bitcoin rises by 10% or 15%, your gain, however, is not the same. Your gain is only maybe 1% or 1.5%. So these are basically the downsides of being a liquidity provider in our system, is that there is a gearing to the downside, but it's relatively limited. Um, if, for example, some of you are very low risk and you say, okay, I'm very happy to earn 7% a year, 7, 8% a year, but I want extremely low exposure. So we have created a buffer pool. And although that's our least popular pool at the moment, the buffer pool is earning clients around 5 to 7% a year at the moment, but the gearing is also much lower. It's just zero point 0.1 to zero point 0.2 times. What that basically means is if Bitcoin falls, let's say by 20% or 25%, you will have a drop in your account of around 2%, approximately, maybe 2 to 3%. So it's very, very robust in that respect. I want to talk a little bit about the team. So obviously, some of you know me. I've been working with Josh um, over the years and assisting, of course, in the gaming franchise. Um, so all of us are financial engineers. Most of us at Hatchworks. We have been around for almost 12 years now. Plus, we have experience at the top investment banks, Goldman Sachs, JP Morgan, graduate from the top universities, all that. All our team is easily findable on the Phoenix website, phoenixapp.io, but you can also go to the Hatchworks website to see the individual members. We have offices around the world, and we'll be also presenting Phoenix in Singapore on, I believe, the 2nd and 3rd of August. Now, one key thing inside Phoenix is the concept known as energy. Energy basically allows people to participate in Phoenix long term. When you download Phoenix, you can look around, you can shop around, you can even start earning once you deposit for the first month for free. But then Phoenix does charge you a small little fee every month, and that's known as energy. And that energy meter that you see to the top right, once you download the app, that starts to every minute it depletes very ever so slightly. And depending on how many credits of cred token that you put inside it, that will basically determine how long you can use the app. So to give you some example, I believe it was from memory, it was around 175,000 cred units for 1 month of access, which approximately is $2 to $3 per month. Those prices will remain fixed over time. We have no intention to increase those, certainly for the first 1 or 2 years. For us right now, the main goal is to increase the adoption of the app to really make it go, become a viral success in crypto, and to help power projects and the earnings potential of projects as well, like Jetstar. So right now, only two tokens are used as energy inside Phoenix. If you want to use Phoenix globally, you can only use two tokens. It's our own token, which is the SXUT, which is quite illiquid right now. It's difficult to buy. It is not on any exchange. And then Cred, which is a bit more liquid. That one is more easily procurable. You can also deposit in Cred, and then you just charge it up effectively. You can charge it monthly as you go, or you can charge it at lifetime, how much ever you want to send to that address. It's up to you. And everything is very clearly explained in the app. Now, a few things, and I'm sure some of you have a few questions. Once you deposit in the app, it can take anywhere from 2 hours to 24 hours for your capital to be committed to the liquidity curve, to the various dexes. And that's because this process is so real. It's not just a Ponzi scheme where you start earning immediately. Once it's committed, you're notified in the app, and you can literally see your earnings trickle in. You can withdraw your earnings every Sunday. What I mean by this is that every Sunday, your capital, your what is called as unrealized fees, they become realized. Our smart contracts do that in the back end every Sunday. So they move over to the withdrawal address, and you can basically withdraw them. Your initial capital that you put into Phoenix, there is one restriction. The minimum deposit is $1,000, and that's because of the demographic that we're focusing on, but also gas fees. Um, and you can withdraw that at any time as well. Just to be completely clear, you just hit withdraw and that capital is sent back to you. In terms of the next phases of the project, right now, unfortunately, the only way to access Phoenix is on your PC or on your Mac. And we estimate that within 2 months from now, you'll be able to also go to a web version of Phoenix and do everything on the web. And of course, that's also fully workable on your Android and Apple iOS device, so your iPhone as well. So you guys will be having no impediments to using the app. So with that in mind, I will hand it back to Josh. If you have any questions, please feel free to ask.
Hey, awesome. Thanks a lot. Looks pretty exciting. Definitely gonna try it out tonight. Oh, am I hearing myself? Definitely gonna try out tonight and test out that 20% API straight away. Like you said, so this is just really sort of really emphasize with everyone. This is sort of slightly different than so basically you're putting your money into liquidity pools, right? So I think, and correct me if I'm wrong, that sort of potential loss that you're talking about, Kai, when sort of Bitcoin, Ethereum sort of moves up and down, that sort of link, that's pretty much impermanent loss, right? And just what the name sort of says about impermanent loss is it's not a permanent loss. It's in very simple crypto terms, you don't lose unless you sell, or in this case, you don't lose until you sort of withdraw. So this is more for the investors who are looking for long-term passive income, who are not bothered or looking at the charts of Bitcoin, etc., and all that, because right now is at 30,000. We've seen it at 69 at its highest. We all who have been around quite long enough know that it's definitely going to pass that mark. And it's just a matter of when. That's another conversation. But and this is not financial advice, but for me, like every time it sort of dips is also an opportunity to sort of come in at a sort of lower price if you want to sort of inject more funds to sort of sort of have the opportunity to sort of balance your APYs there. That's sort of my thought. I don't know, Kai, if you want to sort of talk about and if it's still running. I know you guys. So based on so again, just to emphasize, a really strong team with a strong financial background. You guys also have. This is not your first financial app. You also have Spectre as well. I don't know if it's running, but remember it was. I was sort of heavy on that early days during the bull run. I don't know if you want to talk a bit more of your experience, and then after that we sort of can leave the questions there, just to sort of really emphasize sort of the approach that we have here. It's really finance and passive income focus, and it's from a team who's really experienced in it.
Yeah, absolutely. And also, just going back before I get into Spectre, on your points about the Phoenix app, you're totally right. So the uncrystallized losses, the drawdown, if you will, that term is known in DeFi and in crypto as impermanent loss. So that's 100% right. And yes, and the funds are parked in liquidity pools. And effectively, if you are a bull in the market in general, or you're happy volatility, or you're long volatility, and you believe the market kind of will be range bound, and you want to earn inflation beating returns over the next few years, then this is a great product for you. Now, obviously, if you are a structural bear and you believe that the market is headed to oblivion and we're going to see, Bitcoin at 3K or 5K, and Ethereum is going to go to $300, and there is a cohort of people that believe that, that's all fine. At that point, I would say then you shouldn't be having any funds in the market, because you'll have much better time waiting, going long cash or something else, and waiting and getting it at much lower levels. I don't think that's going to happen. I think the way things are headed forward, I totally agree with you, Josh. It's a matter of not if, but when, and what quantum, what magnitude of the swing we will see. And obviously, capital increases then, and we'd like to earn yield. So this is a very robust and stable solution. You are effectively a liquidity provider. So if you think about it, on Amazon Marketplace, you have inventory when you go there and you sell various products as a seller there. The fluctuation, the value of those products does rise and fall, just not as much as cryptos. Same way here, you go into the market with liquidity, you provide um, either asymmetric liquidity or symmetric liquidity. Our app kind of dynamically oscillates between that. That's kind of quote unquote the secret sauce, if you will. But we do that in a way that has inbuilt hedges so that you're not so exposed to Ethereum and Bitcoin drops. That's why the gearing that I went over, those are negative. The gearings were 0.2, 0.3. It's not like a Bitcoin fell 10%. The value of your capital fell by 10% as well. We that's what most liquidity providers get hurt by. So we've been quite smart on that front. But yes, the concept of impermanent loss is something we understand very well and research very well, and also the way we've devised the app really reduces that significantly. Um, in in answer to your second question about Spectre, yes. So Phoenix is basically our foray into what we've already been doing internally. We have pools active for many years now, and we've also been rewarding our token holders through some of the proceeds of the gains we've made on those pools, on the fees we've generated as liquidity providers. We saw how robust the infrastructure has become at some of these dexes, like Uniswap, for example, really, really robust, not hacked, really secure. And we say, okay, how can we institutionalize this into a product? And how can we make it passive? Because people like passive income. With Spectre, it taps a completely different market. It taps a market where the average depositor is maybe $50, $100. And what they like to do is they like to make a 200-300% return on that per day or per month. What happens in the retail trading market, whether it is binaries or whether it is CFDs, FX, is approximately 70 to 90% of retail traders lose money over time. And this is really painful for those of you that are on this call that have traded binary options, that have traded foreign exchange. You will understand the pitfalls of long-term success. It is very, very difficult to make money. And of course the stress that's involved with watching your positions go out of the money. With Phoenix, you park your capital and that's it. You are literally getting paid every minute. And if you go into the Phoenix Telegram room, they're real users. We have around 50, 60 users already. I think the TVL has hit around 700K. So it's still a bit away from 1 million, but we're headed there. And you can see their experiences. It's a completely different ballgame. Yes, you quote unquote only make maybe 20% return per year, maybe 30% in a good year. And in a bad year, maybe 5% or something, 5-10%. But that's actually return you can use in your day-to-day expenses. With foreign exchange and with binary options and with active trading, this is not always the case, but what we see is most retailers, and that includes most of us on this call, we get stop hunted by brokers, we get scammed by brokers, we get scammed by the market. By scammed, I mean we just don't understand the gyrations of the market. The people that always make money regardless of markets going up or down, are the brokers. And the good news is because of DeFi, you can become a broker now. You can become part of Uniswap. You can become part of 1inch. It's just a smart contract, and you can be a fractional market maker. So we flipped the coin. We basically said, okay, retail has suffered for quite a long time because of all these other reasons when they try to actively invest. Let's allow them to make money passively. And I want to be very transparent here. Josh, you brought up a very good point. What we're doing is it can be done without the Phoenix app as well. It's a bit of a nightmare, and it's taken us 2 years of research to kind of really tame Leviathan, so to put it, to pin it down and say, okay, this is what we can do, and we can do this in a very reliable and confident manner. But of course, there are people on this call that may say, well, the next bull run is coming. Why should I leave capital with Phoenix and waste my cred on powering Phoenix when I'm going to make 10x on Bitcoin? And I would say, yeah, that's fair. If that's your thesis, you should do that. But I think there's a lot of investors and traders who've been burned badly in the last few years, and they understand the value of yield. They understand the value of having cash just sitting around burning 10% with inflation every year, and they want to beat that. So that's the type of market we're kind of going for. Very different to Spectre, though.
Thanks, man. Before we sort of open up the floor, I myself personally have actually 2 questions. One, so I'm I'm your traditional retail investor, so I invest traditionally in things that are low risk, medium risk, high risk, etc., and all that, and not just in crypto, but in all other things as well. But I do also enjoy it, especially during moments of the bull run, right? And we do have some time before that. I believe personally, before that sort of happens. In terms of future developments for the app itself, would you guys be looking at? So now we're looking at 20% APY, which, like you say, in traditional finance markets, that's a bit insane, but in crypto, that's a bit like, oh, okay, 20%, not bad. Would you be looking at higher risks sort of token, like, and I'm talking about like the potential, and I'm not shilling anything, I'm not even invested in it, but just like the PayPays or the next ship, etc., and all that. Would you guys be looking at that, or would you only be looking at Ethereum and Bitcoin? So that's one. That's my first question. Second question is more from a user protection side. So you guys just launched this app. You've been around for the last 12 years, but there's also and like you've mentioned earlier as well. You've seen the biggest boys sort of suddenly crash and burn and disappear, right? And all the funds sort of disappeared. What happens when touch wood, if some sort of black swan event sort of hits and happens again, and then like what would happen if for some reason Hatchworks or the Phoenix app stops? What would happen there? So
These
sort
are
of my
great questions. Yeah, these are great questions. So we start with the second one first. So Six Sigma events, black swan risk. One of the things that kind of us being in crypto for the last 5-6 years since the ICO, a lot of our token holders will know is that what we do well is manage risks. Never been hacked. So much has happened in the last 5-6 years, and a lot of our projects that started when we did, they went down. We are still standing tall. It's not been easy. It's been a difficult 5-6 years, but um, what is all that? What does that really mean? So when we look at what happened to BlockFi, Celsius, and a lot of these centralized lending programs, Nexo still at the moment has survived, but generally speaking, if you look at all these lending programs, you just don't know what was being done with the capital. Yeah, they say your money was being lent out, but there was no real transparency on the lending book. And generally speaking, as we see with FTX, what you saw there was it was basically being prop traded by people who don't know how to trade. And when you had losses there, you had a big shortfall. And when clients started to withdraw, there was a big shortfall, and the companies had to halt withdrawals. And that's what got the SEC involved. Now, the thing is, it depends how you build your business model. If you build your business model prophesizing and advertising ridiculous returns of 50 to 100%. And I'm not saying Celsius and BlockFi did that. We know very well their returns. We ran due diligence on all of them 2 years ago, and we decided not to proceed with those. Publicly, I can go on record and say that because in our chat, a lot of people had said, "Oh, why don't you become Celsius? Look how well Celsius done." I said, "Well, no, we disagree with how they've done a lot of things, and we didn't even put 50K in of the project's money because we just didn't believe it would be viable long term." So the issue basically is that they are taking your money and they are trading it themselves, and they are trading it actively. So they are taking speculative positions on a range of cryptocurrencies and even derivatives, leveraged derivatives on risky DeFi protocols. I can't get into names, but I think some of you probably know them. And you have one wrong move, and your margin just crushes you, and you're gone. And this happens, right? And these effects cascade. So a lot of these big players that went down last year in the US, they had a lot of money in Luna, believe it or not. So those losses from Luna, which were in the billions, they finally made themselves felt in these projects, which were centralized projects where people like maybe some of us had our money in, right? So how are we different? First of all, we don't take your money, we don't prop trade your money because our assumption is we don't know how to prop trade your money. We are financial experts. We could trade if we want, but we don't take your money because the returns we can get by just parking your money on DEXs and becoming liquidity providers are far more stable, adjusted for the risk. The best traders in the world, the best hedge funds in the world, over the last 10, 20 years are doing an annualized 15 to 20%. Those are the best hedge funds. The S&P barely does 9%, 9 to 10% pre-tax. If you on Phoenix can earn 20 to 30%, you're doing a fantastic job given the risk. And so that business model basically is the best. We don't need to take your money and prop trade it. In answer to your question, okay, what if there is a Six Sigma event? What is our Six Sigma event? The money is all in smart contracts. So Hatchworks, by the way, is already a break-even to profitable business. That's the good news. So our runway is infinite. We don't have to dip into reserves or anything like that. It's infinite. It used to be 10 years a while back. Now it's infinite. So there's no risk of Hatchworks going under or the team. But even if there's a business continuity problem, ultimately the money is sitting on the Ethereum blockchain. The only thing that can be a wipeout event for any Phoenix participant is if Ethereum as we know it fails to exist, such that smart contracts no longer can even remotely be interacted with. For those of you that understand a bit of Solidity, you'll understand that you can access smart contracts or interact with them using web-based wallets, but you can also directly interact with smart contracts, nodes, and all that. So as long as the Ethereum blockchain is decentralized and there's no 51% hack, which there never has been, no successful one, and the integrity of the network continues to increase, which it is, a lot of money has gone into it, you're fine. It is an impossible scenario, just to be completely clear, that your funds are at risk. That's what I want to go on record and say, right? In a worst case scenario, and again, this is very unlikely going to happen, but let's say for some reason 1inch and all these dexes, they are targeted by regulators and say you have to shut down. Okay, what happens then basically is those protocols stop providing services, and we, Phoenix, withdraws all the liquidity and we send it back to you. That's all that happens, right? The only way you can lose all of your money is if Ethereum and Bitcoin, the chains physically are broken. They cease to exist. So that risk is, of course, what I call it's more than a tail risk. It's like an unknown almost, because it's so unlikely of that happening, given how evolved the two networks are. Now, of course, if it was a different chain, if it was Solana or something, I would say, oh my God, no, we would never offer Solana-based liquidity farming because we don't trust certain chains. We just don't trust that. But Ethereum is now gold standard for us. It's a very, very, very smart team behind it. And I'd like to also say that for all the people that said, oh, this is an Ethereum killer, this is there, look where we are today. There is no other blockchain out there that is useful. They are all shittier than the next. Every single blockchain out there except Ethereum sucks. And Bitcoin, you can call it a blockchain, fine, it is. That one is good, but everything else, it's just garbage. And I know you guys are on Polygon, and I think that's a good, it's a decision you've taken. And if it goes viral, that's good. It'll give Polygon a good name. They need projects like yours to do really well, but ultimately we bank where we believe it's the gold standard. So that's that. In terms of your first question, yes, we have. So this is the thing. We've just started. We want to show people that we are the industrial strength solution after all the shit that's happened in the yield markets. We want to start off with these more pedestrian returns. I agree with you. 20% it's nice, but it's not like wow, right? But the important thing is that that's something that is bankable, and it is a lot of research and a lot of technology that's gone behind it to make this possible, and that's something that we want people to be able to rely on over the long term, not just 6 months. Not that the bear market comes and Phoenix doesn't exist. So, but does that mean we don't want to add more pools? Absolutely not. So Peppy maybe is not the right example for us, because Peppy, just give me one moment, please. The problem with Peppy, of course, is that we can't hedge the downside of Peppy on a protocol level. So Peppy is a meme coin, and unlike Doge and stuff, it is something that could fail to exist within 3 months. Or a new Peppy could come, Peppy 2.0, 3.0, whatever, and then everyone using that pool would have a very big impermanent loss if there was that Six Sigma event there. So that's not a that's not an outcome we want to even expose our users to, even the highest risk users. We don't ever want to tell them, oh, by the way, this pool does have a lot of meme exposure, so it could be to zero. The good news is, because of the way Phoenix is built, we can offer significantly higher returns on Ethereum and Bitcoin and some of the top coins already. The 20% is actually quite low risk. And for those who are using Phoenix, they'll understand why, the way we partition liquidity between USDC and Ethereum when we create the pools. But if we wanted, we could really, really up the ante and compress the ranges and partition liquidity differently so that the APYs are close to 40% a year. Of course, the risk goes up as well. So the gearing that I mentioned to you of 0.2 to 0.3 in the Ignite pool, which is the highest risk pool, would actually become maybe 0.8, 0.9, which would mean that you're much more exposed now to the prices. And also, liquidity can go out of range, which means impermanent loss can become permanent loss. But you're also earning much higher returns. So we can do this, Josh, and we plan to. We just want to be a bit careful with this. What we'd like to do is get our user base kind of up in the numbers first, and then ask them which pools they would like to for us to provide liquidity for which pools they would like to see added, and then we can of course do that. It's also worth noting that it's not just liquidity on chain and decentralized that Phoenix wants to target long term. You can also now, technology has made it possible to become a market maker on traditional FX brokerages. And so providing liquidity for euro, US dollar, and for a range of other CFDs is possible now. And so that's what we are now trialing internally with some live capital. We have opened institutional accounts with some big brokerages in Europe, one in Australia, and we want to now trial some pretty interesting algorithms to see how well liquidity can be provided there and what yield we can generate. I can tell you that so far what we've seen is very promising, but I wouldn't want to kind of discuss that here. But long term, the plan is to add more investment programs inside Phoenix for sure, and definitely up that bar, that kind of 20%, get that closer to 40%. Whether it kind of gets to 60, 70, 80%, I don't think Phoenix will ever reach those type of returns. I just it's not something we would feel comfortable with, because then we know that we're looking at sure shot disaster at some point. But certainly, I agree with you that 20% is, it's in crypto, it's a bit okay-ish, and we want to continue increasing that, and we have plans to do that.
Awesome, thank you. Maybe one last one just before we open up to the floor. You mentioned earlier about gearing, right? So, and I think you mentioned there was sort of advanced mode for those who are a bit more sort of comfortable or savvy in terms of working with liquidity pools or investments. Did I hear that correctly, or?
Yes, that's correct. So we offer, I mean, we can advise users who really understand liquid pools on how to hedge the downside. So there are people that may say, I want to have zero downside risk. Then we would tell them, okay, but then you need to learn how to short Ethereum and Bitcoin, and we would advise them how the process is done. It's not something that we do on board, but we certainly advise clients on how to short. And there are various ways to do this. Some have higher risk, some have low risk. There are some associated costs that bite into your APYs from this. It's not too big, but yes, we do assist advanced clients on this as well.
Okay, awesome. That's all pretty neat. I mean, the app is pretty clean. I'm sure looking at some of and I guess because a lot of our community are sort of always either on the move or always checking the markets or doing transactions on their phone. So obviously that there's this when mobile version is out, which you guys are working on, the web version that will be available on mobile, obviously. So pretty excited to sort of try it out later. Now I'm going to sort of open it up on the floor. So if anybody sort of have any questions, please put them out now, and then we can sort of try to address them as best as we can.
Sure. And just one thing I wanted to also add that that Jay reminded me of. Jay is our brand ambassador. He's on the call as well. Is we have alongside the web version, which is coming out within 2 months, is we also have the affiliate program. So what we have seen among the few users we have now, 50 to 60 users, is a lot have been telling their friends and family to bring over capital and try it out, and we've seen that. But of course, it would make sense to reward them for this. So the current affiliate program actually rewards users for referring new users to the app. So if you bring a friend, you also get a chunk of the fees that we generate as Phoenix, we give to you effectively as an affiliate share. The user doesn't see lower APYs. So the friend that you bring, they will earn the same returns as you, but just Phoenix gets a bit less, and you get an affiliate fee. So we're building that affiliate program out as well.
That's pretty cool. That's pretty interesting. Actually, I was thinking about this thing of like, because there is this small barrier to entry, right? Well, and when I say small, it's actually not that small, depending on one which part of the world you're from, and two, obviously also depending of your financial status, right? So it's a minimum $1,000 deposit. What are your thoughts on this? Because this is sort of an idea, and I have to sort of give opportunity for those with lower, sort of, who have less opportunities to sort of create, for Jedstar specifically, a combined pool where you can, maybe start at $10, $50, $100, and every time we reach 1,000, we can sort of, deposit it within the pool itself. And then as a sort of combined Jedstar pool as ourselves, because obviously you can use cred, and then with what we're doing with KD Arena, right? So KD Arena is going to launch in a few months. And I'm actually going to Vietnam next week. We're speaking to like 30, 40, 50 games, Web3 games specifically, some with tokens, some without, specifically just NFTs, but mostly with tokens, to sort of, this is also a good way for us to sort of introduce them. One, because they'll be using credit anyways on KD Arena, two, to give a sort of DeFi opportunity for them, and to also create their own pools, or if they're investors who sort of are able to do so, for us to actually gain some referral from there as well. So like I was sort of thinking about this kind of sort of combined thing. This is just an idea I was having while you were speaking. Obviously it needs to be thought about, because the mathematics behind it is going to be pretty heavy. But I don't know, what are your thoughts? Is that something you think that will be achievable and possible? I'm sure in some ways it is. It's just going to be not that easy to execute.
Yeah, I think so. It's definitely, you're spot on. You're right that the way we structured it, because of gas fees, because gas fees on Ethereum still are a bit of a problem. So we amortize them over the pools. We don't amortize them on just one person or two participants. And with small deposits, anything under 1,000, it creates, basically puts Phoenix into losses on a per client basis. But equally, the program that you have suggested makes a lot of sense, and that's certainly doable. And we're definitely exploring already for the past few weeks on how to lower that minimum substantially, from 1,000 to maybe $100. And ideally, a micro pool concept or structure that you just suggested would make a lot of sense. So where cred would have its own pool and the minimum entry is $10 or something, that's certainly something we would love to explore with you. It is of course a big stopgap to adoption, having a minimum $1,000 deposit for sure. And also having it just PC and Mac based is another problem, because obviously these days we're in a mobile era and people like to have financial apps on the fly. So both of these issues will be addressed very shortly. I'm happy to talk, Josh, in terms of how to structure that once KD Arena is live, to create a micro pool, so it really allows the masses to kind of get in to Phoenix, and of course they have to use cred to power it.
Awesome, thank you. Okay, I'll really stop talking now. So I'll open it up to the floor. If anybody has any questions, please shoot them, and then as I said, we'll try to address them. It's really a great opportunity, because we have the Hatchworks team here that you guys sort of know. So they're pretty much the heavy financial background. So especially for those who have questions of, what liquidity pools are and how does it work, and any other questions that sort of related to the app, you should give it a shot.
Josh, we have a question from Ronin.
Go ahead, Ronnie.
Yes, you might have to unmute to speak. Ronin, you there?
Okay, I was speaking, but I thought I was speaking. Okay, hi. Really nice presentation, and the app. It's like, yeah, it's bringing knobs like me for the staking. So I wanted to ask two questions. That is, when we send USD, we pay the fees. When we do the withdraw, we also pay the fees of that withdraw or not. So if the Phoenix application has a mean of sending the USDT to our wallets without the fees being taken out of our gains, because the fees in Ethereum are crazy. And am I speaking?
Ronan, yes, please go ahead.
Okay. So, and the second is if different applications for our money are being studied. Yeah, you spoke about now the other pools, because what frightens is do you think that there will be users for this because of the high fees, and with the bull run that we are expecting at least to start at the end of this year, the beginning of the next one, the fees in Ethereum is going to be skyrocket, so it's going to be crazy. So just my question, just general questions. Thank you for the presentation.
Thank you, Ronan, for your feedback and your questions. So I start with your last question first. The Ethereum, if it rises in a bull market and volumes really increase, that will translate to very heavy APYs. So on the pools that we have presented to you, we were seeing APYs of 3 times that. A 20% pool was doing 60% generally in the that's last year. The volumes right now have declined a lot because there's a lot of uncertainty in the market and people want regulatory clarity. And so in answer to your question, when appetite returns and volumes go up, yes, fees will go up unless Vitalik Buterin and Ethereum.org solve the holy trinity to get decentralization, security, and speed all tackled at once. But fees will continue to be an issue, but that doesn't mean fees translate to you. That's very important to note, because you're not paying fees per transaction. We're amortizing them on the whole pool and only on withdrawals from the pool. Okay, so each week we collect all the fees that are earned for all pool participants in one smart contract, and then we send that to another smart contract, which allows you to withdraw to withdraw it to your balance. Now, it's worth noting that the biggest fee here is us sending it, and we absorb that from our fees. So that's something we absorb. We don't pass on to the user. There is a small fee that you are going to pay for withdrawing, but that amount is broadly negligible. I mean, it's I think it was something like $7 or something if you withdraw your entire capital, and lower if you're withdrawing your fees on a weekly basis. This is getting around fees. I mean, in answer to your first question, I believe it was, do you pay any fees for depositing money into the pool? The answer is no. There are no fees there. But it is worth noting that if you're going to come into Phoenix with, let's say, $1,000 or let's say $500 in an event that we have reduced the minimum from $1,000 to, let's say, $100, fees are always going to bite and erode into your returns, whether it's these gas fees or whether it's the fees of just energy, right? So let's say you have a depositor who puts in $100 into Phoenix and they want to make 20 to 30% a year, right? Yeah, okay, they make $20, $30 on that $100 deposit, but the cost of using Phoenix is $2 to $3 a month. So all of their earnings are being completely eroded by that. So this is why the product is kind of currently catered to a more higher income demographic, people that are depositing kind of $5,000 to $10,000 plus. That's what we have seen in our kind of 50 to 60 users. The average deposit size is 6K. You have a few whales, you have some small Minora as well that have put 1K, 2K. And of course, there have been many users that have said, like, I want to come in with $100, $200. And we've explained to them that we're working on reducing that. But because gas fees are always going to be an issue, whether there's a bull run or bear market, it's just worth factoring that into your calculations as well, that if you are going to be becoming a liquidity provider on Phoenix, or even in general outside of Phoenix, this is something that you have to do it with some capital. To get around this, we have, of course, also looked at Arbitrum. Arbitrum is a level 2, layer 2 solution, which has gained a bit of traction in the last few years. And liquidity mining has become a bit popular in Arbitrum as well recently. There are some liquidity pools in Arbitrum that allow Phoenix to connect and provide its services. We're monitoring those to see how the volumes are going. At the moment, the volumes are not that exciting, or the APYs are not that great that justify us to actually create a pool out of it specifically for you guys. But in answer to your question, that's kind of the fee situation. The best thing you can do is, if you do plan to join it personally, is to just shoot off your questions to us, either in the Phoenix chat on Telegram, or just via an email to support@phoenixapp.io. And you can tell us which fees that you're concerned about, or you can also go to the FAQ in the app. We explain the fee structure, how that breaks down there as well.
Yeah, I guess just sort of add on to that. I guess that's sort of why it was really important for us to, when we sort of launched the Phoenix app, to really sort of have, and this is why all these questions are really important, to sort of have this AMA so that you can ask these questions, because it's when you look at it, it's a very targeted audience in terms of we're talking about barriers of entry, but also in terms of general lifestyle, etc. and all that. And that's why, from a Jedstar point of view, we do want to sort of give it access to sort of everybody in some sense. So we would definitely, Kai, just to sort of your point later, we'll definitely sort of look at ourselves creating a pool to give access to people who want to sort of participate and look at it. Now, just to sort of reply to the gas fees, just to Kai's point in terms of the market entry. So when he talks about the whales, or people who sort of people coming in at $5,000 or $6,000. So if we look at $5,000, easy math, right? 20%, that's about $1,000 APY. 20% is about $1,000. Then your gas fees is between $2 to $10, depending on which time of the day and when you're sort of doing it. Right now at this state, but obviously we've seen gas fees of up to $1,000, and I think that's the scary part, which I hope you guys have sort of thought about when that sort of happens, because that's more than just eating on your APY. That sort of literally drains your APY, your gains. But that is sort of I guess.
For that, I would say don't.
Yeah, no, just to finish, I guess I would say myself personally, I have two types of investments. So one is the really high risk, high rewards. I see this as a lower risk, lower rewards. So 20% APY would be like, yes, minus gas fee once you withdraw, yes, minus gas fee once you need to send it somewhere so you can cash it out, if it's not directly to an account where you can cash it out directly. So that there's a sort of those few things that you sort of need to take into consideration, but still, it's still better in any ways compared to anything that we sort of see in the financial market right now in terms of traditionally what we get in terms of returns of the money that we sort of just literally park aside and let sleep kind of thing. If we're not talking crypto.
Yeah, that's correct. I think that's absolutely the correct way to look at it. And I think if you look at yield programs in crypto, if one actually measures the mean return for yield programs in the last 3 years, DeFi yield basically became a thing over the last 3 years or so, since DeFi had its boom at the end of 2020, early 2021. And actually the mean return in yield terms is probably negative for most yield programs. You had some crazy good programs which were ultimately basically glorified Ponzi schemes that worked for some months, but then ultimately yield is measured on an annual basis. We call it APY, and by the time the year is up, most of these schemes are gone. And so if you actually look at, for example, if you had money with Celsius or BlockFi and stuff, ultimately in the end you probably lost money, right? What they have done is they've resorted to, even if you made money on an annual basis of 8%, 10, 15% with Celsius, if you withdrew your money before the debacle, you were forced to give it back because of clawbacks. So you actually lost money on many of these yield programs. So if we can get people to see that, okay, yes, 20% on face value for crypto gross, it can also be 25, 30% depending on markets, but let's say 20%. Net is maybe closer to 17% after gas fees and all that. That is prima facie, that is low, or a bit boring, but it's worth also noting that it's more sustainable as well. It's something that is relatively bankable over time. And I know that most crypto people won't see it that way. They'll be like, okay, well, this time it'll be different, but just want to highlight that it can go very wrong as well. Because most of these yield programs that offer 40, 50, 60, 70, 80, 90%, they don't last for over a year. And that's the big problem. So if you're in it just for a few months, then yes, that probably is more better for you. But if you're in it for long term, it's not a place that I would personally be comfortable in parking capital. But in terms of gas fees, it's absolutely it's a good point. And sure, we will look to create that liquidity pool for you guys, a dedicated one. So the gas fees are just amortized over thousands of users, and it's no single user faces a big hit. One thing I'd want to say is that if you are in a situation where you're in a bull run and gas fees have moronically hit $1,000 again on the Ethereum blockchain, right? Because some CryptoKitties type of project has gone viral. I would urge you just not to do anything, then just wait till the gas fees come down. They always come down to palpable levels, just it takes a bit of time. There's no urgency to withdraw, is what I would say, because you're not looking to lock in. Yeah, I was just saying you're not looking to lock in a gain necessarily because you're getting paid in USDC, and USDC will always be 1-to-1. So yeah.
Can I just say, and I don't want to make this a brainstorming session or a debate, but and I'm sure you guys might have thought about it, because I'm sure you guys are looking at from every angle. But USDC is available not just on Ethereum, but like on Polygon, BSC networks, etc., and all that. So I understand Unipin, how Unipin works, 1inch, etc., and all that. So it's most likely going to be on the Ethereum blockchain. But if it's something eventually, especially if you increase your TVL, for you guys to receive a sort of USDC on Polygon or whatever chain that has below dollar kind of gas fees, and then you bridge it to the Ethereum version, pay the fees on your side, and then after that do your thing kind of thing. Just throwing an idea. I don't want to make it brainstorm.
No, absolutely. So that's the reason we're kind of looking at Arbitrum. We're monitoring both the liquidity pool side of things, but also then for the fees. And it's a great idea of yours, and it certainly makes sense to use bridging where appropriate. Currently, I think we do not. Sorry, I was thinking of another project that we have on Spectre Exchange where we are using USDC for AVAX on the AVAX chain, but you're totally right. I think that's something that we can do as well, so that gas fees don't become such a problem, especially in the next bull market.
Thank you. Is there any question? Any more questions? Sorry.
I have one. Is there an option where we can actually have auto compounding done for whatever rewards are earned?
So thanks, Aslam. We have received a lot of requests for auto compounding. It's something we're looking into. The reason we haven't done it at the moment is because the fees associated with adding newly generated funds in a real-time basis to the liquidity pool, because this is not a Ponzi scheme. Each time we commit funds to a liquidity pool on chain, we absorb the fees. We don't pass it on to the user. So imagine if you, Aslan, if you have let's say a $1,000 account and you've made $3 in fees in the last week, we have you have it set to auto compound, we would have to take those $3, move them around a few smart contracts, and get it into the liquidity pool for it to be actually committed. In doing that, in getting $3 there, it would probably cost us $10 to $15. So if we can get around that problem, then we can do auto compounding. And our team is looking into some things that can be done to enable auto compounding. And I understand why you would want to have that done, but it's a bit mathematically difficult from a fees perspective at the moment.
Thanks.
No worries. I mean, one thing that can be done, of course, is that you auto compound every 6 months. That would make life a lot easier. But for real-time auto compounding, it's quite difficult. The way it's mainly because it's a real project. Like if we were, if it was a Ponzi scheme, then we could say, yeah, just press that button, and now you're earning, instead of $3 a day, you're earning 3 raised to the power of whatever, right? And yeah, but it doesn't work like that in the liquidity pool side of things.
Totally agree. I think, well, I mean, if there is a possibility that you could integrate Arbitrum into with a bridging solution, and once the gas fees is kind of negated, that is a time where you could really look into the aspect of having these real-time compounding done.
Yeah, good idea.
Okay, we actually passed the hour, so I think we spent a lot of time. I think maybe I just sort of asked one question, sort of related back to one of my earlier questions. It's so right now, just to sort of summarize what the Phoenix app does before I just hit my question is, so just summarize basically what we're doing together as I would say this, I'll just really summarize in a very easy way. What we're doing together as a community, and I'm talking as the Phoenix community, whether it's from the Jedstar community, whether it's from the Hatchworks or Spectre community, is sort of provide liquidity together into Ethereum and Bitcoin, and then after that sort of get those gains together. You guys do all the sort of hard work on the back end just to make sure that everything sort of goes okay, because it's not that easy to sort of be a market maker or providing liquidity, or the gains are not really that high when you do it yourself. Because if you try to provide liquidity on on Uniswap, the gains are really low. You don't get your 20%. So obviously, this is a huge opportunity for us retail investors to be part of that market making and to still get the gains that sort of really reflects in a much better way than what traditional sort of finance would. My question is, like, when would the credit liquidity pool be available?
Sorry, could you just repeat the last bit? You just got cut off. When will it be available?
When would the credit liquidity pool be available? And I'm just teasing you.
I mean, we can start the micro pool.
Putting you on the spot there.
No, look, we can definitely discuss the micro pool idea that you had, to get the community together, lower the minimums for sure. We would happily like to do that. I think that would make sense. When you say that you have a sizable community that's kind of ready that wants to get in, it would certainly be something that we can do on our side. For sure.
Because in my sort of perspective, compared to most of the rest, because when we talk about, like, we were talking about Pepe, and guys, again, I'm not shilling no financial advice. I've not invested in that token at all. I've stopped investing into meme tokens. At least for this case, you guys have direct access to leadership. So if anything, if shit hits the fan, we are not walking away or walking out. And there's an opportunity for high PYs, especially during the bull run, or when Web3 gaming sort of cleanses out that all that bad sort of juju or had last year. It might be an opportunity for much higher APY for you guys as well. Just throwing an idea.
Yeah, absolutely. I mean, look, we have no problem with that at all whatsoever. I mean, ultimately, we just the composition of each pool. We just look at the underlying assets and see what is the volatility structure. So we don't, for example, we don't have pools for our own tokens, mainly because there's no liquidity in them. And the main reason behind that is because our token is a dividend-paying token. It's a security, so can't get on any exchanges. This has been an issue for over half a decade now. But obviously, if we see good volume and we see good liquidity behind any token, certainly yours, we would be crazy not to add it. We would love to add it. What becomes dangerous is if a token can, go from $1 to 10 cents in a day. The impermanent losses there are just so high that can have a reputational impact on not just the pool but also the entire product, if that makes sense. Because sorry, Josh, go ahead.
I don't know. I was saying 100%.
Yeah, exactly.
uh,
I think definitely when you guys become a known gaming token, which you will, I think it would be a no-brainer for us to definitely add a pool with great APYs as well. And yeah, because the only reason we provide liquidity for the main tokens like Ethereum and USDC and of course also Bitcoin is because of how less volatile and how liquid they are relative to the other tokens.
Not totally understand, and that's sort of the purpose of the app itself. That's sort of just planting the seed so that I can have further conversations with you in the next. Then we see where it goes in a few months.
That's for sure.
Awesome. I feel it's a great call. For those who are in front of PC, I really recommend you guys who are interested in really looking at sort of if you already have whether it's within, and again, this is not financial advice, this is you guys have to do your own due diligence and your own research. If you have already all these sort of really lower risks but in the traditional finance lower sort of APYs in terms of the returns on your dormant sort of income or sort of liquidity, this is a really good opportunity to sort of look at different options. Definitely one that I myself personally am looking at. And having been working with you guys for a few years now, knowing you guys personally, and I feel pretty, and we are pretty much on the same page when it comes to kind of grab the bullshit of it's all about safety of investment, and it's all about, it's not just about crazy ass numbers, it's just about reasonable gains in the long run. That's sort of when it's a bull run, then let's go for it. But now, between now and then, what are we going to do with our sort of dormant liquidity pool, our own personal dormant liquidity pool, basically what you have in your bank? So really love this product. Definitely will give a look. I'll put in a few hours later to sort of really test it out, to give my own personal feedback to the community and to you guys as well. And yeah, if you have any closing words, because I know, sorry, we sort of passed the hour.
No, it was great. It was really good having this chat, Josh, and thank you for the opportunity. Also, thanks for the questions, also to the community of Jedstar. Really, really great to see how you guys are evolving. And of course, we look forward to creating more utility for the CRED token. It already is gaining more momentum in the gaming side of things, and hopefully on the financial side of things as well. It'll be great to see you guys there as well.
Awesome, thank you. This was really good. So thank you guys for all joining. And if you guys have any questions, I'm gonna share it again, but it's already pinned in the chat. So sorry, maybe not the Telegram group for Phoenix. We'll sort of pin that. If you guys have any questions, you can ask us. But obviously, the best people sort of ask it from is from the Phoenix team themselves. We can sort of provide answers based on sort of what we know, but if it becomes too technical in terms of what happens on the back end, the best would be to sort of ask the team. So we'll share all the details there. And thank you once again, and speak to you guys soon.
Thank you so much. Thank you, everybody. Have a good one. Bye-bye.
Thank you.